Hello investors and welcome to my YouTube channel where I study the best investors and businesses from around the world. Today we'll be looking at why Berkshire does not believe in dividend investing. There are countless investors talking about investing in dividend stocks. There is a ton of content about trying to build passive income through dividend stocks. Some investors buy stocks just because they pay out high dividends. Is this logical to buy stock just because of a high dividend yield? Although it seems logical, investing in stocks purely for dividend is almost always an unwise thing to do for anyone who is trying to invest in stocks to build long-term wealth. In this video, we're going to listen to Warren Buffett describe how companies pay out a dividend can actually be a bad thing. Now, let's examine what he has to say when asked about dividends. Well, it depends on what they could use that or how they would utilize that cash or what they could use it for. Those are more focused enterprises than Berkshire, at least in terms of products, and I think I commend management that have a wonderful business for utilizing cash in those wonderful businesses or in businesses that they understand and will also have a wonderful economics for getting the rest of the money back into the shareholders. So Coca-Cola, in my book, is doing exactly the right thing with its cash. When it uses all the cash that it can effectively in the business to expand into new markets and all of that sort of thing, but then beyond that, it pays the dividend, which distributes cash to shareholders, and then it repurchases shares in a big way, which returns cash on a selective basis to shareholders, but in a way that benefits all of them. So you will benefit from us not paying dividends just as long as we can use every dollar we retain to produce more than the dollar value of market value over time. I can't promise you that, but that is the yardstick by which the decision is made, and that is the yardstick I think by which Coca-Cola is making the decision too. And I think that they deserve great credit for exercising the discipline to quit when they are using cash when they've run out of the opportunities to use it well, and then to further deploy it advantageously by repurchasing shares. I think one of the things that I admire about my friend Bill Gates is that he's got $4.5 billion of cash in Microsoft, and very few management can stand having $4.5 billion of cash and not doing something unintelligent. So far, it's made sense for us to retain everything that we earn, and I think it'll make sense for a while longer, but it may not make sense indefinitely. And when Warren Buffett was asked why Berkshire doesn't pay dividends like Coca-Cola, which pays investors a reliable dividend that yields about 3% per year, which is about 1.6% yield from the S&P 500 stock, he said, "In terms of not paying dividends, we don't pay dividends because I think we can turn every dollar we retain into more than a dollar of market value. The only reason for us to keep your money is if it becomes worth more by us keeping it than it would be worth if we gave it to you. And if we can create more than a dollar of market value for every dollar that we keep, you're better off whether you want to take that dollar out by selling a little piece of your stock or whether you continue to leave it in. That's the test. If we come to the conclusion that we can't do that and we could come to the conclusion sometime, then we should distribute it to you. The interesting thing is, we're in certain businesses, for example, See's Candy being one. We don't have a way to intelligently use all of the money that See's generates from within See's Candy Company. So See's were a standalone company, it would pay a very large dividend, not because it just has some dividend paying policy. It would simply be because we wouldn't have a way of using it in case of $30 million a year intelligently and expanding that business. The Buffalo News is the same way. We don't have a way of using money within that specific business intelligently to use the money that is generated. We hope that in the overall Berkshire Hathaway scheme of things, that we can intelligently use money that the companies in aggregate generate for us. And we think so far we have, and we think the prospects are reasonably good that we can continue to do that. But dividend policy should really be determined by that criteria, also bearing in mind the possibilities of repurchasing stock too, but They should be determined by whether a dollar left in the business is worth more than to the shareholder dollar paid out. Some places like Coca-Cola, if Coca-Cola had paid no dividends and simply repurchased shares and developed the bottling system and done things that they have, the shareholders probably would have been even better off. They've been sensationally well off as it is, but they probably would have been better off than they have been with the dividend policy that they have had, and Gillette and Disney and companies of that sort that have got these terrific opportunities to use capital within the business or to repurchase shares of a company that simply can't be replaced. That usually is the best use of capitals. To truly appreciate what Warren Buffett is saying in the video, you have to understand why a company would even pay a dividend in the first place. Let's use Kroger, a company that Warren Buffett owns a lot of stock in, as an example to demonstrate why a company would pay a dividend and why the decision to pay a dividend could actually be a bad thing for long-term investors. Kroger is the United States' largest supermarket by revenue and the second largest general retailer. Kroger made nearly $2.6 billion in profit in 2020. Now that's obviously quite a bit of money, so what exactly is a company supposed to do with all of those profits? The first thing Kroger could do is reinvest some of those profits back into the business. This could be fixing up stores that are getting old, or even expanded the business by opening up new locations. But of these things would be considered capital expenditures or investing back into the operations of the business. After reinvesting back into the operations of the business, there are a few other things that a company could do with the money that is left over. The company can pay dividends, which are simply cash payments to shareholders received for owning the stock. Kroger did that in 2020, paying out $534 million in dividends. The other thing that Kroger could do with the extra money is to repurchase shares. When a company repurchases shares, it decreases the number of shares outstanding and, as a result, makes each share of a company represent a larger ownership stake in the company. Kroger did that as well, repurchasing $1.3 billion worth of stock in 2020. So now that we have some background about why a company would choose to pay dividends, that raises the most important questions in the video. Why can dividends actually be a bad thing for investors? Here are the two main reasons why dividends can actually be bad for long-term investors. The first point is that dividends may not be the best use of capital. Sometimes companies pay out dividends instead of growing the business. By doing this, companies sacrifice the long-term health of the business for the short-term benefit of paying a dividend. This is the main point Warren Buffett was getting at, is that it would have been a bad idea for Kroger to pay out a large dividend when it was a smaller company and growing rapidly. Instead of being paid out as a dividend, the money was better used in growing the business, expanding into new cities, and making the company more profitable over the long term. This applies to Amazon right now, another stock Warren Buffett's company, Berkshire Hathaway, owns a small part of. Amazon is growing rapidly, and it needs every dollar to be used to continue to expand. Whether it's building new warehouses, hiring more people, or expanding Amazon Web Services, there are many attractive areas for Amazon to spend its money growing the business. Amazon should only start paying dividends when the company has more cash than areas for the company to use cash to generate high returns for investors. The second point is, most companies can't maintain extremely high dividend payout levels. There is a pressure on a company's management to always be raising the dividend of the company payouts, despite changes in the underlying performance of the company. Sometimes the dividend gets to such a high level that the company can no longer continue to pay large dividends. These companies are commonly referred to as dividend traps. Naive investors will buy shares in a company because it is a really high dividend yield, only for the management of the company to cut the dividend substantially because the company doesn't have the ability to continue paying the dividend. This is what happened recently with AT&T, which was providing a 7% dividend yield. Shortly after the company cut its dividend in half, the stock price plunged. Investors who bought the stock for the dividend lost far more money due to the stock price decline than from a few dividend payments they received. So where do you fall on the dividend debate? I'd love to hear your thoughts and maybe the other side of the high dividend investment in the comment section below. Thank you so much for watching, and if you like this video, please share it with your friends and family. It helps the channel a great deal. Leave in the comments section your thoughts about the video and who I should cover next. With that said, thank you guys so much for watching this video, and I'll see you in the next one.